Good afternoon, and thank you all for joining us. I'm Sebastian Burka, Associate Director of the Stigler Center. Today, we're happy to host Leo Perry and Karthik Ramanna in a conversation on the Wirecard scandal moderated by Bethany McLean. Before we begin, please note, we are on the record and we will post the video on our YouTube channel later. If you have any questions for the speakers, we will try to address them in the last 15 minutes or so, and you can submit them via the Q&A icon at the bottoms of your screens. As usual, views expressed by our guests are their own, not those of the Stigler Center or the University of Chicago. We hope that you will join us for more upcoming webinars, including one on whether antitrust should promote economic liberty on October 19, as well as the next installment in our series, Freedom of Speech, Hong Kong and the Future of US-China Relations, which will feature Jimmy Lai and Steve Davis on October 22nd. Please check our website for more events, as well as our publication, promarket.org, and our Capitalisn't podcast, co-hosted by our faculty director, Luigi Zingales and Bethany. And back to this afternoon, please allow me to briefly introduce our speakers. Leo Perry is a fund manager at Ennismore Fund Management. He is a Wirecard short seller who, as the Financial Times put it, long believed that Wirecard was a fraud. Karthik Ramanna is a professor of business and public policy at the Blavatnik School of Government at the University of Oxford. And Bethany McLean is a journalist, author, and contributing editor at Vanity Fair. And now, without further ado, I turn it over to the speakers. Thank you.
Hello, everybody. Thanks very much for being with us. Karthik and Leo, thanks very much for joining us for this. We are here essentially to answer the two questions that always get asked in the wake of one of these things, which is, how could this have happened and how can we prevent this in the future? And I suspect the answer to the first question is going to be quite a bit more satisfying than the answer to the second question, but maybe I'll be surprised. Anyway, so I want to start with this very basic question: what happened? So let's start with Leo. Just tell us the start of your long adventure with Wirecard. What was it that first got your attention?
Sure. Well, it was a company actually I looked at on and off over the years. You know, there were allegations in 2010 by a German shareholder association, which ended up, getting them in legal trouble and actually ending up in jail. So there'd always been questions around the company. But most of the work I did was in 2014, by which time it had achieved quite a lot of scale, and there was quite a number of years of sort of information. But so, it was part of a broader, approach to short selling, which I've taken for a few years by then to really look for what I thought was fraud. In this case, it didn't take long, frankly, looking in 2010 to be, about the business, and in fact, to come to the conclusion that it was almost certainly a fraud. I mean, a matter of days or not weeks even. They were a serial acquirer, which fine is a business strategy, which may be legitimate, but in their case, the transactions always look very peculiar. The amounts paid for the businesses seem, cash flow at different periods, different years even, and wouldn't tie in with other sources. So it was immediately clear that there was something, at least something very strange about the acquisitions that they'd made.
And you've called it actually an obvious fraud, which I think is interesting, and that's because of this issue that the acquisitions seemed to be wildly overpriced for what it was that they were actually buying. Is that one of the things that made the fraud obvious to you?
Yeah, I mean, that was definitely the starting point. That there were these acquisitions which just frankly didn't make sense. I think they'd be acquiring something that they'd either disclose almost nothing about it, or you could find the accounts for what they had bought, and it was clearly very insubstantial. And so there was clearly something wrong there. And what was unusual about Wirecard was that, particularly from sort of 2010 on, these transactions were incredibly well documented in terms of the accounts of the business they were buying. So we got information in the notes to some of the sort of accounts of businesses they'd bought, which gave the names of shell entities they'd used, the names of fake customers, fake products. This was, an incredible amount of disclosure to get. So it wasn't just, they looked odd. We could actually sort of follow through and find that, even named customers didn't exist.
Karthik, in the big picture, when we look back on this fraud that was going on for such a long time and that Leo describes as obvious, does it surprise you that it took until 2020 for Wirecard essentially to be brought down?
I suppose it does, because there were folks like Leo and folks like Dan McCrum of the FT that were raising questions about this for a very long time. And there were some very sophisticated insiders that were involved, EY and the German regulators and so forth, BaFin, that were looking at this. And the fact that they looked at it and came to a different conclusion when the facts on the surface of it looked so unusual, to me, that is especially disheartening or especially worrisome about the situation. If it were a relatively obscure company, or if the time frame had been even half as long as it actually turned out to be, then perhaps I would have had a little more faith in the capital markets system as a whole. The fact that it's all taken so long, despite all of these players, with a second look and a third look and so forth, that is worrisome.
Yeah, and I want to come back to why that might be. But Leo, back to you. You helped the FT write that first series of stories in early 2015. Were you surprised that it had as small of an impact as it did? Did you expect there to be, now a reputable publication has written about this, it's got to be over now?
Yeah, so in sort of being in sort of like 2014, I had a few meetings with Dan McCrum, an NFT journalist who'd written about some other sort of similar goings on at some UK companies that we were familiar with, and just talked him through what our suspicions were around the acquisitions and later the kind of receivables as well, where there was appeared to be a large black hole. He obviously, went away and did his own work. He went out, for example, to Bahrain to check on what we believe was the fake customer there, and as you say, ended up writing that up over the course of 2015. Yes, still with most of what we consider to be frauds, is that when they get that kind of exposure, they tend to collapse fairly quickly. People lose, particularly investors lose faith in them. It sort of spirals out of control quite quickly. So it was certainly, based on our experience of the previous few years, quite a surprise that there's been no reaction to that, given the nature of what was being suggested.
I think, why do you think there was so little reaction to those first stories in the Financial Times? It's not as if it was a known publication.
So sorry, go ahead, Leo.
No, you go. Sorry.
So I think that the two groups that I want to focus on in answering that question, one is EY, and then the other is BaFin, the German regulator. And I think in the context of both of them, you probably get slightly different responses. In the context of EY, I think it goes back to some very serious conversations we've been having in the United Kingdom over the course of the last couple of years about the nature of the audit industry and whether the audit industry has, in some sense, the right culture of challenge and the right set of incentives put in place by the fact that they're also active participants in the consulting space. Of course, this is not something that's unique to the UK environment. This is something that is prevalent across the audit industry worldwide. But for some reason, this conversation is really very salient in the UK, but much less so in other parts of the world. So I think this really brings to light once more the need to have that conversation. We haven't solved that problem in the United States. We haven't solved that problem elsewhere in the world, and we are perhaps furthest in at least raising public salience on that issue in the UK. So that's issue one, and we can unpack that if need be. The second issue is, of course, the German regulator, and to me, it highlights one of the concerns with this model of German capitalism, which is often called a stakeholder model of capitalism, where there is a sort of a coziness between the various entities with the intent that they're all advancing a common set of state interests, whether it's employment or environmental interests or indeed, aggregate wealth creation. But we saw some version of this story with what happened with Olympus in Japan a few years ago, where the Japanese regulators were similarly quite reluctant at first to do much in this space. And so my sense is that we should have some serious conversations about what does German stakeholder capitalism, or what is the role of German stakeholder capitalism in the sort of outcomes we've seen with the role of BaFin in this context. And I think particularly in the context of there being growing momentum in the US and the UK to have a conversation about the future of Anglo-American models of shareholder capitalism, and the German model being held up as some sort of not a utopia, but certainly a model that is closer to where it is we'd all like to go. Perhaps there's a moment of reckoning here with the German model too.
Utopia or dystopia? We're going to come back to that question, but I do want to pause. I want to talk about the accounting issue for a little bit, because I do feel a little like this is a little bit of Groundhog Day, because way back in the wake of Enron, the conversation was exactly the same. It was that perhaps accounting firms are fundamentally flawed because they're tied to their consulting business. And then somehow we passed regulations and we got rid of the consulting businesses. Here we are 2 decades later in exactly the same situation. So it's a little bit ironic. But Leo, to you, a question for you. How is it, EY has said this was a very sophisticated fraud, they were duped, there's no way they could have seen this, but how can you, sitting on the outside, have seen it if EY, with access to everything they could have wanted access to on the inside, couldn't see it? Did I lose you, Leo? Or I'm not sure let's see. Can anybody hear me?
I can hear you.
Yeah, we can hear you.
Okay, Leo might be cut off. I'm not sure he can hear me. Let's see. Well, Karthik, why don't I just turn that over to you and see if we can get Leo back in touch. How do you think it is that an outsider could have seen this so clearly, and yet those on the inside couldn't see it?
Well, that raises some very serious questions for EY, certainly, because EY will have to do some serious reckoning publicly as to how they missed something so obvious. The scale of the fraud as we're looking at it is really quite egregious. There is, of course, the cash flow issue, which is, why did EY not seek more direct verification of the cash balance, especially when it was such a significant sum of money in a series of banks that you would not expect a DAX 30 firm to be banking with. So that, I think, is an obvious question to ask and be answered. But then there's the fact that so many of the clients were simply manufactured, and so much of the profits were manufactured. So these were fake clients and fake companies that effectively in any basic audit process should have come up. I think it's going to be a really serious reckoning on part of EY. They have to take this very seriously, because we'll all want to know how they missed it. Now, there was a letter sent out by the CEO, the worldwide CEO of EY, to all of the EY clients recently, and some people have read that letter as a in some sense an indictment of EY itself. The fact that the global firm has taken this so seriously that the global head of the firm has written to every client arguing that stating that they will look into this and so forth. To me, that suggests that there might be a much greater degree of trouble at EY than we're initially being led on to believe. The nature of the fraud is very serious.
Leo, are you with us again? Can you hear me?
I am. Yeah, I can hear you now. Can you hear me?
Okay, good. Yes. So I'd love to turn
Okay,
that. How could you have seen so clearly on the outside what EY couldn't see on the inside, or chose not to see?
Well, yeah. I wouldn't characterize it as chose not to see. I think it's more a question of what are you looking for, and neither an auditor or a regulator really are mandated with looking for fraud. That's the bottom line. And I think it's an important point to make. I mean, Karthik mentioned Olympus. There's quite a big distinction I would make between Wirecard and something like Olympus, where Olympus was a real business that got into trouble operationally, and unfortunately management chose to hide that. I guess in the hope that they could make up the loss the next year and it would never get discovered. And I would guess that most of the time that's when a little bit of fraud, that's what happens, and you never hear about it. Sometimes the loss just gets bigger and bigger, and in the end the black hole gets so big that gravity takes over. Wirecard was different, at least that's my understanding. Clearly, we don't have documentary evidence that our thesis was right. We know how it ended, and so I'd be very surprised if it wasn't. But my understanding from the accounts is that this was a fraud from day one. The business was essentially, a sham, that they were faking revenue and therefore materially overstating profit from day one. And so, that's very different to something like Olympus, and particularly in terms of how you look for it. And I think, in a lot of ways easier to spot, because it is, this was not a sophisticated fraud, to be honest. It was fairly blatant, and in some cases it was kind of laughable the way that they tried to cover it up in the accounts. I suppose my point is, it's not about that these people chose to look the other way. They just weren't looking at all. Basically, there's no proactive sort of mandate for an audit to look for fraud, or proactive sort of team within a regulator looking for it.
Which is interesting, because then that does seem to be a more systemic issue than a specific issue. In other words, the idea that there is no mandate to look for fraud, and therefore you don't see what you're not looking for, seems to me like a systemic problem. Karthik, would you agree with that?
So I wouldn't agree with the idea that there's no mandate to look for fraud. I know the audit firms like to tell us that there's no mandate to look for fraud, and that's been part of the way they have responded to the criticisms in the UK of the audit industry, what happened here with Carillion. But quite frankly, I mean, one of the things the audit should, now, I think we want to make the distinction between expecting the audit firms to pick up every single instance of fraud and what it is the purpose of the audit. So the purpose of the audit is really to provide, in my view, a second set of eyes on the underlying judgments that effectively justify the accrual estimates that are in financial statements. And as part of providing that second set of eyes to say, okay, does this judgment square with our economic intuition and with our reality, say, for instance, with non-impairment of goodwill, in the process of asking those questions, they should actually be able to certainly sniff out the most basic or elemental types of fraud, like we saw in the case of this particular firm, Wirecard. And indeed, there are many very specific processes in the audit, in the nature of the audit, that are geared towards discovering deliberate attempts at obfuscation. So for instance, if somebody is trying to forge a bank statement, then part of what a good audit should do is triangulate that. say, okay, well, let's go back to the source. Let's talk to the bank manager every so often. Let's ensure that we have a wide representation of people we're speaking to in the bank so that, you know, we don't end up with a situation where we've got pretty structural cash flow fraud. So, I mean, part of what a good audit should do is ask some questions that will lead you to detect fraud when it exists. We don't expect 100% success rate, but I would absolutely push back against any audit firm CEO who argues that it's not the purpose of audits to detect fraud. And in fact, one of the audit firm CEOs did testify in Parliament to that effect I think a year ago here in the UK. And the blowback was enormous because that's certainly not how you know, many ordinary people would like to see it.
So then is the issue that EY got lazy, or is the issue that they were simply incompetent, or is the issue that there was some kind of explicit corruption going on?
So this is the question, and I think this is why perhaps Carmine Decidio, the CEO of EY, is so nervous about the whole situation, which is to what extent, and I think we've laid out three possibilities there, was this sort of explicit corruption on part of EY, which is obviously, you know, very, very serious. Was this just gross incompetence, which is also serious, or was this some sort of, you know, cultural conditioning to look away from, you know, these sorts of situations? So not a deliberate attempt on part of EY, but just because the structure of the way the culture is set up within the firm, they weren't asking the right questions. That's probably the most defensible stance for EY from the perspective of the long-term sustainability of the firm, if it lands on that conclusion. But quite frankly, at this stage, the jury is out, because if it were one of the first two, then that is really sort of at the core of what EY is supposed to be doing.
Leo, do you have a view which of those it is in the case of EY? Is it explicit fraud? Is it incompetence? Is it some kind of implicit corruption that dissuades audit firms like so many others who are supposed to be the gatekeepers from actually keeping the gates?
Yeah, I'm not going to speculate on too much on that, but you know, I think the reality is that the structure of an audit process is not really suited to identifying fraud. I mean, Karthik mentioned checking the bank statements, which is the one thing they should do, and clearly didn't do thoroughly enough in the last couple of years. My guess is that was only an issue for the last couple of years, that Wirecard bank statements were only really faked after it became impossible for them to do more egregious acquisitions, or more fake acquisitions, and that maybe was you know, as a consequence of the FT coverage, that, you know, it just became impossible to do that. So, you know, some hope that it did actually have some effect. But before that, you know, an audit process just, you know, isn't looking at the aggregate accounts and saying, do these make sense? That's not what an audit does. It looks at a sample. It says, is there a paperwork to support this sample? And that's just very, very easy to fake. You know, you just have to set up a, you know, a shell company, you know, have a friend set it up and send an invoice, and then you've got an invoice. So, you know, the audit process is not really designed to, you know, whether you think auditors should or should not, you know, actively look for fraud, they don't, and the process is not designed to it.
Interesting. So there's an old maxim that I've heard since the time I started to do skeptical stories on companies, and it looks like Wirecard disproves this maxim. The old maxim is that it's really difficult to fake cash flows. Would you, and Leo, in your experience and with looking at Wirecard, would you say that's not true? It's really easy to fake cash flows?
Well, it's hard to fake cash. I mean, you know, ultimately, you know, the sort of nuclear option is to go and fake the bank statement. And, you know, actually, if a company's doing that, then the fraud does become very, very difficult to stop. You know, one of the recent examples in the UK was a company called Patisserie Valerie, which, you know, was faking its bank statement. And, you know, but there was not, you know, any other obvious signs in the accounts. You know, it was profitable where, you know, claimed to be profitable where obviously it wasn't, but it wasn't that egregious. a few years before that, we had one called Glovo, which again, was something we were short of, and that again was faking its bank statement, but it was so egregious that it was obvious. So it is, if a company's going to go to that extreme, actually, and the auditor's not picking up on it, then it is very difficult to spot from the outside. But in terms of, so yeah, actually faking the cash balance is an extreme option. But covering up fake cash flow is, again, relatively easy if you can get away with basically, buying a shell company and claiming you paid 10 times, what you actually did for it. That is, or some other kind of fake assets. So, as long as people are tolerant of that, then you can get away with it, and that's what Wirecard did for the best part of 15 years.
There's also a philosophical issue, Karthik, that strikes me, or philosophical question, maybe philosophical is too grand a way to describe it, but that makes Wirecard very different than most other business frauds or stories of business gone wrong. And that's Leo's contention that it was a fraud from the beginning. This wasn't some sort of accidental slide into fraud as a cover up a bad quarter to perhaps paper over a business that wasn't performing well until it could kick into gear, but it was an orchestrated fraud from the beginning. Do you agree that that makes Wirecard rare and different?
Well, I don't know if it makes it rare and different, but I certainly think that all the more reason it doesn't excuse the audit firm, right? Because now you're increasing the likelihood that the auditor should pick up on some of this over the course of what would otherwise be some seemingly random sampling. I mean, as far as we know, as of now, and of course these data might change, about a third of the revenues and about 80% of the profits were just absolutely fabricated. Those customers didn't exist. I mean, even a random sampling should have picked that up. So to me, it's just, it's bizarre that the auditor would miss that. And as Leo suggested, there are so many cases of companies fabricating their cash statements or their bank statements. There are so many cases of companies trying to manipulate their cash balances now, that kind of audit of the cash trail should basically be part of any kind of proper audit. I mean, the fact that the auditor says, oh, if somebody tries to fake the cash flow, we won't be able to tell. Well, now people are doing it. Well, that should be part of what you do. That's why you have a monopoly. You have a legal mandate as an audit firm. You don't have to go out there and sing for your business. The client has to purchase the product, and there are only 4 of you. If you're a Fortune 500 company, basically you pick from the big 4. So you got to work harder, guys. That's how I would look at this.
It's interesting because it's almost as if these companies have taken that old playbook. Oh, it's really hard to fake cash flows, and said, aha, this is the recipe for how we're going to do this going forward. Leo, hammered away at EY a fair amount, and in my view, deservedly so. But in the pantheon of gatekeepers who failed, there are others we should talk about as well, including the German regulator. So let's actually just pause there. Let's start with the German regulator. What went wrong?
Yeah, I mean, maybe just before I move to that, on auditors, obviously the focus is on Ernst & Young here, but let's be honest, all listed company frauds, and there have been plenty, have been audited. All of the big 4 auditors have audited frauds over the years. So it's, I wouldn't necessarily single Ernst & Young out. It's not a, I don't know. Maybe there were specific cultural things there, but it strikes me as much more a structural issue that an audit just is not designed to look for fraud. An audit company is hired by the company. And so it's much more, a structural issue with audit than them specifically. And then, so okay, moving to regulators. Yeah, again, the reality is that I can't think of many frauds where the sort of denouement was instigated by the regulator. Sometimes they help it along towards the end, particularly in Europe. And again, it's just not something that they actively look for. Maybe they should, and certainly for this kind of fraud, I think that's the easiest remedy would be for them to have a kind of proactive team looking for it, because short sellers are pretty effective at doing it, and it would be much easier for a regulator to do it. because they can, force much more disclosure. But in this case, and particularly in the case of, in Germany, I think there were cultural factors which just meant that, the regulatory environment was particularly favourable for fraud, because it was, almost disbelieving that it could happen.
And what were those cultural factors? Why didn't they believe that this could be happening?
Yeah, I mean, well, certainly, from, as I say, I think, if you look at the frauds that have been exposed in recent years, recent decades even, a large number of them have been driven by short sellers who are, clearly highly motivated, and, there's, not a strong culture of that in Germany, frankly. There are, not very long short funds there. Short selling is, I think, viewed as something, parasitic almost by a lot of market players, and so you don't have that kind of domestic base there, and that meant that the critics have always been overseas, and so there's sometimes been a natural tendency for Germans to sort of defend against what's seen as overseas kind of parasitic behaviour. And we had when I was looking at Wirecard in 2014, I was aware of the experience with, VW, Porsche, and then US hedge funds, which had tried to pursue that through the courts in Germany, and got nowhere. I was also aware, of course, of what had happened to the German, shareholder association, who brought up issues, obviously rightly with Wirecard in 2010, I think it was, and it ended up going to jail for a different reason. But my point is that the German regulator at that point had chosen to side with the company, when in fact, both parties were guilty of wrongdoing, and it really escalated from there. And I think they ended up, kind of psychologically committed to defending the company, and that went on and on over the years and got more and more ridiculous, frankly, to the extent that they ended up suing the FT journalists for publishing whistleblower claims. So I think it was a whole host of small factors, rather than any one thing. But I think Germany, for the last 10 years was a particularly favourable place to pull off this kind of a fraud.
So Karthik, it's interesting. We were talking about this a little bit beforehand. It's almost as if the German regulator played the role, or fell into the role that a company typically does, and that if this company is different in that it was an orchestrated fraud from the beginning, the regulator sort of slowly got sucked into the fraud over the course of it. Does it surprise you that happened, and are there things we can do to make that not happen in the future?
Well, again, I'd say I am a little surprised that it has happened, because I would have, quite frankly, expected the German regulators to be more sophisticated about the way they approach this. It looks like that there was a fair bit of, let's call it a cultural closeness amongst the elites that were involved in lobbying for Wirecard. It turns out the Chancellor's office was involved in lobbying for Wirecard as well. Former Defense Minister of Germany was on the payroll of Wirecard, and right, and then so the regulator is part of that process. So, but quite frankly, I would have expected the German sort of elite to be a little more skeptical and fractured amongst themselves than this is all played out to be. I mean, to an extent, we saw some of that with Enron, I suppose, 20 years ago when Ken Lay was, I guess he had some sort of role in the Bush, you'll remember better than I will, but he had some sort of role in the Bush administration at the time. And my sense is that there was a degree of cultural closeness amongst the elites that were involved in overseeing Enron that perhaps led to Enron getting away with as much as it did. American elites are far more fractured today than they were 20 years ago. And at least in this sense, I think you get a little more of separation of powers across the various institutions of governance. You certainly get some of that here in the UK with the role of the independent media and the FT and places like that doing good journalism. but I guess you get a lot less of that in Germany than we would have hoped for.
So one of the things that often does fracture that homogenous view is the role of the short seller. One of the things that punctuates the elite myth building, if you will, is the role of the short seller. Leo, it's always surprised me because I often think, well, this is supposed to be a market. There's supposed to be people who believe and people who don't believe. And yet somehow short sellers there's much more negativity around short selling than that very pure intellectual view would have it. Leo, does that surprise you? And is that part of the issue that it's still too easy to demonize short sellers?
Yeah, I think there was certainly some of that here, and to some extent, some of the coverage around the company helped them in that sense. In that, there were some allegations which, while they may prove to be true, were much harder to verify. And so, effectively over the years, the company kind of became inoculated. Every year, there'd be something, and some of it was, some of the stuff which was not around the accounting was a little bit easier for them to dismiss. Not to say that it wasn't right, but it was much easier for them to defend against. And so, then it really became, a sort of demonization of the short sellers. But what was, I suppose I found particularly surprising was that in this case, German investors, well, not just German investors, there were some UK funds in there with big holdings too, were willing to believe effectively that the FT was on the payroll of short sellers, the FT journalists were. And that was an allegation, I heard the Wirecard CEO make openly at a group meeting to investors. And, the response from a number was extremely positive. That, of course this was right. This could be the case, So that I find, I still definitely find amazing. Not that even short sellers were kind of dismissed because clearly they're highly incentivized, and no more so, to be fair, than non-investors are. And non-investors seem to get a pass on making extreme claims about a business's prospects, but if it's the other way around, then it's market manipulation. So I think what was peculiar here wasn't that the short sellers were dismissed, but that actually the Financial Times, the serious investors were very comfortable, assuming that the Financial Times was on the payroll of short sellers, and seemingly unwilling or unable to read basic accounts, which would have given them the answer.
Why is that? If we can, in other words, if we can come up with at least a plausible explanation for why EY got it wrong, why the German regulator got sucked into this, but big investors, any investor should want to know the truth, right? That's what they should care about at the end of it all. So how can an investor get so deluded by a company when their interests are very, very clear? They want to know the truth and want to know what's going on.
Well, maybe they don't really, as long as they make money. At the end of the day, if someone bought Wirecard and made a load of money over 10 years, and then sold out before it blew up, were they a good investor? Not really, because they couldn't, see the obvious fraud, but they were a good trader. And they certainly made a lot more money out of it than I did. So, I'm not sure that kind of assertion that most investors are looking for the truth is really true.
Yeah, isn't that interesting? What a powerful role confirmation bias plays, right? Karthik, back to you. Do you think we could fix? Do you think things would be a little bit different if short sellers weren't just demonized? And demonized may be too strong a word, but is that a fix to offering more clarity into these situations?
Well, I mean, I guess what this lesson has suggests in the context of Germany is that perhaps they should be taking the role of short selling more seriously. Whether that is then the lesson we extend to the US or the UK, that I'm less certain about. I think that, perhaps in the US and the UK, short sellers have the degree of flexibility that is perhaps socially appropriate. And there is obviously a role for short sellers in this, but let's not try to overread their role in society. And Leo sort of alluded to this as well. And there are cases where they might be quite destructive and willfully and maliciously so. So we should, with all of these institutions, the idea is that they serve as checks and balances for each other, particularly when there's a strong monetary incentive involved, as with short sellers. That's where the regulators have to play a bigger role, or the audit firms. We have to find a way to address the culture and the conflict of interest problems that we've been talking about. But I'll just very quickly touch on your question about why did the investors, like SoftBank, for instance. And I think that in many of these cases, it's other people's money. Right? So let's be honest, the nature of the compensation structure in many of these asset management firms is such that, a lot of asset managers get well paid regardless of performance in an absolute sense because of relative performance. And so if it's other people's money you're taking big risks on, that's always a much easier thing to do. So that might be part of what's going on here.
I think that's a very fair point. I also thought Leo's point earlier about how Wirecard essentially inoculated itself from criticism, because a little bit of overreach, a little bit of an accusation that can't be backed up suddenly becomes inoculation even against very serious and real accusations. It's interesting.
I think I'd make a couple of other points on investors. I mean, on SoftBank specifically, actually, it was their own money. It was management's money, but they immediately flipped it to other investors, so they didn't really take any risk. But more importantly, actually, a large amount of money in the market is passive investing, or at least, effectively passive. Maybe a bit overweight or underweight in index, but they're not. The majority of money in the market is not actively looking for fraud. Fraud is just taken as a sort of cost of doing business, and particularly for tracker funds. So if you can get your fraud to a certain size where it qualifies for an index, you suddenly have a huge number of fraud buyers. So there's actually a huge bias in the market, a huge part of the market which is just not looking for fraud. So that's true for investors, it's true for auditors, and it's true for regulators. And that's why I think there is a role for short sellers. It's, as I say, a role that the regulator could do itself, but for some reason chooses not to. And for me, I'm glad for that.
I've often joked that if all the fraud went away, you wouldn't have a business model, and I wouldn't have a business model anymore. So therefore, keep it coming. But does that? I'm joking. But does the fact that more and more money is moving toward passive investing actually mean that instead of things getting better from here on in, it might actually get worse, because there's less and less incentive for the very people we would expect to be literally invested in uncovering fraud to actually do so?
Yeah, I think I think the idea that you're going to kind of get rid of this kind of fraud is it's certainly not going to come from investors. It is, as I say, for a large part of the market, just a small cost of doing business. And in most cases, these frauds blow up, way before they get to Wirecard scale. They're just a small, a few out of 1,000 holdings, and they're sort of irrelevant. So they're sort of a cost of doing business, and to some extent, maybe a reasonable one, because the alternative is to force every company into massively more onerous disclosure when you would hope most companies are genuine. So I think the reality is they're always going to be there, but there is that kind of added bonus for them now. The more money there is tracking indices, the easier it is to get scale and kind of get a self-fulfilling kind of scale. So that certainly helps.
Karthik, what's your view? If this moment should be a transformative moment where everything could be better from here on in? Actually, just this tangent, I'll never forget President George Bush in the Rose Garden in 2002 when America's Sarbanes-Oxley law was signed into law, saying, you know, from here on in, the world is safe for individual investors, and it's all going to be great. And then we had the financial crisis just a few years later. But anyway, do you expect a watershed moment where things change, or do you expect to still be back here in another 20 years discussing the latest big giant collapse and the complicity of all the gatekeepers and what went wrong?
Well, I mean, you know, human nature will be what it is, and that's why auditing has existed. It evolved in sort of, you know, an unregulated competitive context because of the underlying sort of, you know, instinct in human nature to perpetrate this kind of fraud. And so, you know, we're not going to completely eliminate it, but I think that we're in a particularly dangerous moment in history, particularly in the Western world and in Anglo-American societies. When Enron happened, actually it happened on the wake of the first dot-com boom, which was perhaps one of the, certainly from the perspective of hindsight, one of the best periods for you know, market capitalism at any point in the post-war period. I mean, that was, if there were a brief moment in history when it looked like Frank Fukuyama was right, and we were indeed at the end of history, and, you know, free markets and liberal democracy had triumphed, it was in the late 1990s. And you know, Enron came in the wake of that, but it didn't fundamentally shake our belief in market capitalism. The financial crisis has actually affected the way a lot of people view market capitalism in America and in the UK, and you know, and particularly young people. And that was over 10 years ago, and we haven't really recovered from that loss of confidence in market capitalism. And if anything, things have gotten a little worse. So for crises like this, in this moment in history, it's actually profoundly dangerous. A couple of years ago, I wrote or a year ago, I wrote a report for one of the big audit firms on their internal culture of challenge. And the report is public. And one of the things that I argued for is this is an existential challenge to not just to the audit industry, but also to capitalism as a whole. So if you don't take this seriously, you know, you'll kill the goose that's laying the golden egg for you. So I think that this is particularly dangerous moment when you look at what the political alternatives are and the kind of political movements that are gaining currency across Europe, across America, and across the Western world more generally.
It's a really interesting point, and I've wondered post the financial crisis as well how much more room we have to tolerate failures like this that are clearly failures of the system and not just isolated failures. But back to something you said at the beginning, Karthik, which is that this also might be a challenge to at least one alternative to the very unbridled shareholder capitalism model we've had in the US, which is that Germany was supposed to be all about stakeholder capitalism, and that was supposed to be a better path. And yet some of the things that make that path perhaps better may arguably have contributed to this. So does this mean, in your view, that stakeholder capitalism should be rethought as well?
Well, not necessarily that it should be rethought. Obviously, it has its advantages and it has its strengths. And you know, I mean, wages for those at the lower half of the distribution of skills in Germany are clearly better than they are in a relative sense than in the US. And so for a lot of people, living under that system is a better system. And so, you know, let's not throw the baby out with the bathwater as well. But I think it does alert us to the dangers of that model, which is that there isn't enough of the skepticism amongst the elites who control these sort of institutions that are supposed to provide checks and balances on each other. And if there's one thing about the adversarial nature of the US system or the UK system, it is that it keeps these sorts of forces in check. Now, of course, the financial crisis was in the US and Enron was in the US. And so, you know, one could say, how well did that work? And you know, we were all sort of drinking the Kool-Aid with the financial crisis, or most people were anyway. And so, you know, I think we have to just be humble about this, and every one of these systems is really going to have its flaws. The lights in my office are turning off because I haven't moved, so I have to get up and do that.
So back to that idea of complicity of the system. A question for you from Luigi Zingale. More, it's sort of a two-part question. More than Enron, he asks, Wirecard looks like Parmalat. And I'm not sure if you're familiar with Parmalat, but if you are, I'd love to know if that's true. But the second question that I'd definitely love your take on is, where was the board? Was this a failure of the board of directors too?
So again, you know, I would still distinguish Wirecard from Parmalat in the sense that Parmalat was a very large real business, you know, and Wirecard wasn't. It was very easy to prove that just by trying to find their customers, which didn't really exist. It was very easy to see that. So yeah, you know, there were more similarities with Parmalat because yeah, it ended up taking the cash balance. But as I say, that was really very late. I assume that was very late in the story. So I actually wouldn't say it's particularly comparable to Parmalat. It's much more comparable, frankly, to you know, any number of kind of penny stock promotions that you get it, you know, year in, year out. The only difference is that it got very large, and you know, that went. Yeah, it's an embarrassment for Germany, and yeah, also actually a bit of a problem for the management because they'll end up going to jail. Whereas if they'd shut it down when it was smaller, they probably would have walked away free. So you know, I think it's easy to kind of, you know, look for a systemic answer to this, but I'm not sure it really is that important. It's you know, a simple con that got out of hand.
Karthik, what do you think about the role of the board of directors? Is this something we need to rethink, or something that has caused you to question how effective boards are?
I mean, maybe less so from this case, but more generally, I've been struck by the degree of deference of non-executive directors or independent directors to management and to auditors on these sorts of questions. You know, if you're staking your reputation on the line as becoming an NED or an independent director on a board, my sense is you'd want to, you know, take some of these questions very seriously. And given, you know, as Leo suggested earlier, this was a sort of fraud from the beginning. It makes it particularly odd that the board didn't pick up on this. But you know, more generally, the issues have been that the boards are perhaps insufficiently involved in the selection of the audit firm. I've encountered CFOs who have effectively said, well, we appoint our auditors, even if that's not what it says. So, you know, de jure, de facto, we appoint our auditors. And you know, that any self-respecting NED would consent to that. Boggles the mind. Why would you take that risk? The auditor is there precisely to provide a second set of eyes on what the CFO is doing. So the boards just don't seem to be as aggressive as I would like them to be. Part of that, I think, has to do with the sort of people who get appointed to boards. They tend to be ex-CEOs and ex-CFOs, and perhaps they have a greater degree of empathy for management than is useful in these contexts. So my sense is that there is actually a role for greater skepticism. I mentioned in another interview last week about a story an NED told me about how when he joined a board, he kept quiet for the first year. And I was thinking, gosh, that doesn't strike me as particularly smart, because by the time you feel it's appropriate for you to open your mouth, you've probably sort of, you know, drunk the Kool-Aid. And in fact, it is in that first year when you notice things that are out of ordinary and you ask questions that you might actually have the most impact. And my sense is I'd much rather have a board that over-inquires than under-inquires. That's part of the governance role they should be playing, but that's not quite the culture in most boardrooms.
Isn't that interesting that it is cultural in the end? And maybe that is, maybe you just identified a really interesting problem, which is that because you have ex-executives on boards, they treat the executives of those companies with the deference with which they were treated, and they expect that deference to be in place rather than a more challenging, skeptical approach that someone who hadn't grown up in the clubhouse might take. Leo, question for you from Hans Stegi. He asks, what about the role of large reputable counterparties like Mizuho, Credit Agricole, Citigroup, SoftBank, etc., that did deals with Wirecard despite the controversy? How do you think those supposedly independent actors who continue to do deals with Wirecard, and which does actually lead me to another question that was mine that I had not gotten to, but which was that $3 billion in cash had to come from somewhere. Who gave Wirecard the cash, and why did banks continue to do business with them?
Yeah, and it's different answers in different cases. I mean, obviously, SoftBank, as I say, effectively structured the deal so they immediately sold it on. Or sorry, it wasn't actually SoftBank, but SoftBank executives. So they effectively put their name on it, but immediately took out all the risk. But yeah, again, it sort of speaks to my suggestion that if you want to avoid this kind of thing, particularly of it getting large, it would be relatively easy for a regulator to do if they wanted to proactively. All they had to do was go to Visa and say, what's your transaction volume? What's Wirecard's transaction volume over your system? And they would have seen that it's a tiny fraction of what the company claimed. We couldn't do that as a short seller. We'd love to have been able to, but for a regulator or some other kind of entity, it would have been very straightforward. But for the most part, those other third parties are not going to proactively sort of volunteer that information. So it does need someone to force it. And they're also probably not going to proactively flag if a company is, let's say, overstating its relationship with them because there's nothing in that for them. There were some real parts to Wirecard's business. They bought some real business. They bought Citibank's, acquiring business in Asia, and prepayment card in the US. So some parts of it are still operational. So that gives a sort of veneer of something real, and obviously includes some real relationships. But those third parties, I think you can't really expect them to flag up when they think that their relationship is being overstated.
Another question from Lucas Davies, which is fascinating. How do you approach, as a short seller, how do you approach the timing and sizing of positions in a situation like this, where you're right, but the market is, and the market thinks you're wrong? How do you go with what you know and say I'm gonna risk it all because I know I'm right, or do you?
Right. Yeah, so I mean, there's two approaches there that I know of that have worked. As there's always been to have a highly diversified book of positions. We know in any given year, in any given year, usually a few of them will work out. But not to put too much risk on any one position, because if they take the route to zero that Wirecard did, then it's very hard to make money out of them. But as long as most of them, and historically most of them have gone to zero a lot quicker, you can do that, and you can tolerate a lot of volatility in an individual position because it's not a big part of your own overall book. The other method, and within that, I suppose we try and persuade other people, like the Financial Times, to look at what we're seeing and to put it out there, so there is a counter argument, because you are effectively on your own often in these short positions against a management and investor base which is very very promotional. The alternative is to, which is something we've never really done, but is to take that to the extremes, the kind of thing that Carson does at with Muddy Waters, and is to make a very strong case as you can, frankly, and be as vocal as you can about it, and to take a relatively short-term position around that, so you can control the narrative. I think it's worked, very well for them. It's not something for me. But those, I think, are the two options. You either need to be very diversified, particularly if you're trying to focus on frauds. You certainly don't want to take a large amount of risk on one position. And Wirecard is probably is one of the best examples that you can get of that. But there are even better ones where outright frauds have been acquired, and so then not only does it take a long time, but it doesn't ever go to zero. You definitely don't want a large amount of risk unless you're going to go and try and control the narrative.
So I wanted to close on a last question for both of you. Karthik, if there were one change you would want to see coming out of this, what would it be?
Well, I don't know if it's necessarily a change, but I think that, in general, more of an adversarial system, or the sort of the separation of powers argument that's part of what I think makes the US work as well as it does, is what we want to see in the capital market system more generally. And the more collusive the system, the less likely we'll be able to find these things.
Leo, your thoughts? If there were one thing that could put you out of business as a short seller, what would it be?
Yeah, I mean, I think commercially, I wouldn't necessarily wish for it, but I think it would be relatively easy for a regulator to do the kind of job that an activist short seller does in terms of looking for fraud, and to do it much more easily with much more information. So, it would be relatively easy if a regulator wanted to proactively, stop these frauds. Certainly, stop them getting to any kind of scale. They're always going to be there at the kind of low end of the market, it's probably not worth the effort. But it would have been relatively easy for the regulators, or any regulator, to proactively do that. But certainly in Europe, none of them really do, and maybe a little more in the US, but still, certainly they have the tools to do it, but not necessarily the will.
Well, thank you all so much for coming to this. I think we learned a lot of really interesting things, but for me, the giant takeaway for this is the old lesson that to see something, you first have to be willing to look at it, right? You first have to be willing to acknowledge it might be there and be willing to look at it. And Karthik and Leo, thank you so much for sharing your expertise, and everybody have a great afternoon.
Thanks, Bethany. You're welcome.
Thank you.